Hi, good afternoon, everybody. My name is John Williamson. I'm one of the partners here at Portfolio Strategies, and I'm super excited to give everybody a PowerPoint presentation on our most popular program, Tactical Evolution. And with me today, I've got John Kimbrough in our Dallas office. Say hi,
Hello.
John.
It's good to be here. I'm going to enjoy this presentation. I know I have some of my own qualified money in this program, and I really think it's a great strategy and look forward to the presentation.
Thanks, John. And if you have any questions, we'll give contact info for John and myself at the end. But the stars of the show today are Megan Paul and Rich Paul. Rich was the inventor of Tactical Evolution back in June 1st, 2002, and he'll tell you how great the program is quantitatively and qualitatively here over the next few minutes. But he has the pleasure of working with his beautiful daughter Megan for the last couple of years, and so those two are going to help us give you a little more info about Tactical Evolution, how it works, and what I like about it is it's so uncorrelated to almost any other program that literally you could put this program as a 5 to 15% allocation in any portfolio, no matter what mix of mutual funds or stocks or bonds or REITs that you have, and it would lower the drawdowns, hopefully even increase returns, but it's just been a fantastic program. So with that, Megan and Rich, I'll let you take it from here.
Okay, thank you so much, John, for that amazing introduction. We are really, really excited to be here and have the opportunity to talk to everyone about Tactical Evolution. So thank you so much for the opportunity. First, before we kind of dive into the nitty-gritty, we just wanted to share a little bit about ourselves so you can get to know us. Dad, you kind of have the longer work history, so do you want to kick that off?
Sure, Megan. Thank you. Thanks, everybody, for the great introduction. I've been investing in mutual funds since 1965, actually, and became disillusioned with the stock market in the early 70s during what was the worst bear market since the Depression. And got out, and back then I still always had an interest in the stock market, and as an engineer, I was very technically oriented. Heard about technical analysis and market timing and active management, and so in 1979 I began to use these strategies, quantitative analysis, technical analysis. Started an investment club. I worked at the Johns Hopkins Applied Physics Laboratory, got together with a bunch of my co-engineers and scientists, and formed a club to trade stock index futures using these active money management timing strategies. Did great. That led to the formation of a company in 1987 called Potomac Fund Management. I founded. I had also been using my strategy actually before the stock index futures came out in 82. In 79, trading mutual funds and with market timing and asset allocation, tactical asset allocation, trading different mutual funds. So in 1987, started up Potomac Fund Management and continued actively managing client money, and for a number of years using a more subjective type of technical analysis until 2002, when I began experimenting with mechanical systems, and this is what led to the formation of what is now known as EVO, which I started at my former company, Potomac Fund Management, in 1982. So I've been registered as an investment advisor for 32 years. Recently, I was appointed to asked to be on the board of the RIDEX Mutual Funds, which is a division of the Guggenheim family of mutual funds. And the RIDEX funds are what we use in our strategy. And I've used them since their inception, actually, in early 1990s, having known the original founder of the company. In 1990, I was one of the co-founding members of the National Association of Active Investment Managers, wrote their performance measurement and presentation standards. And last year, I entered into what they call their Shark Tank investment strategy competition and won. So, and again, we are using our strategy that we're going to talk about today. and presenting that for that competition. With my former company, I had sold a majority interest in 2003, raised over $100 million with that company, and sold a majority interest in 2003. I ran the Evo strategy from June of 2002 until the end of 2003 as the owner and portfolio manager. And subsequently, I licensed to the Potomac Fund Management for a number of years thereafter, and eventually I had a non-compete, so I couldn't provide it to anybody else, any other advisors. Finally, I eventually sold my remaining shares, which in 2014, which lifted the non-compete, and I wound up getting some interest in the strategy after actually entering the Shark Tank strategy in 2015. Came in third at that time, but actually we had the longest track record. It raised a lot of interest, and so at that time, we were managing only about $1 million, primarily my own money, actual assets, and we started to license.
This is about actually and this is when I kind of entered the story in 2015. So I had been working for about 10 years in fintech. I started off at American Express, where I was building out one of their new emerging payment platforms. And following that, I was the head of product at a financial planning startup called LearnVest. And we were actually acquired just about the same time that Dad was really getting up and going with licensing the tactical evolution signals. We were acquired by Northwestern Mutual for that financial planning software that I directed and I built. So that was a really fun time, and I kind of got to take a deep breath and decide what I wanted to do next. And Dad mentioned in 2015, we started to get a lot of interest in Evo, and you can start to see why when you look at our track record and our long-term performance. Our 3-year annualized return is about 9%. 7-year, we jump up to almost 15%. Same with our 10-year. And basically, since 2015, we now are moving over $300 million in the Evo strategy across some of our partners like PSI. So we're really proud of those returns, and we'll talk a lot more about our performance later on and the amazing growth that we've had just since 2015 when we started licensing. And we really believe in the strategy. We have a lot of our own money in it as well, and are excited to tell you more about it. So just talking at a very, very high level about the strategy, as my father mentioned, tactical evolution is a mechanical system that generates buy, sell, and short signals based off of algorithmic rules using quantitative analysis. And kind of the main takeaway there in that giant mouthful of technical words is that there is no discretion used whatsoever. So in a 16-year track record, its birthday is tomorrow, my dad has never once overridden one of the signals. In that 16 years, we have 182 total round trips. And when we do execute a trade, we use the RIDEX S&P index funds. In particular, when we go long, we're using the NOVA fund, which is a 1.5x leveraged long fund. When we go short, which is very, very infrequently, we're using an unleveraged short fund. And otherwise, we're in cash. We're in the money market fund. And when we make these trades, we're making them 100%. So we're either all in or all out. There's kind of no fancy allocations or anything like that. So starting to get into the system design and really the concepts that are powering the algorithm and providing a foundation. First speaks to how did tactical evolution, or sometimes you'll hear us say EVO for shorthand, how did it get its name? And when we look at the word evolution, it really does an excellent job of explaining the strategy's development over the years. So evolutionary, a gradual process in which something changes into a different and usually more complex or better form. And we will hopefully prove to you that we have in fact evolved in that positive direction over time. And the second concept that is really the backbone of EVA's strategy design is this concept of aggregation. So there is this MIT professor who we really like. His name is Edward Thorp. Some of you might know him as the author of Beat the Dealer. There's also a movie based off of that. He's also a portfolio manager at one of the best performing hedge funds. He wrote this article in a JPM in the journal Portfolio Management, and what he found was that academic research indicates that when multiple trading systems are aggregated, the noise and errors will tend to diversify away while the signal remains and is more robust. So, keeping those two concepts in mind, we are going to dive into a little bit of how the black box of tactical evolution actually works, how it evolves over time, and how we use aggregation in order to get the best results. So when we go back to 2002, when my father first set out to build tactical evolution, where he started from was really looking at a universe of 40 different trading systems. And oftentimes we get lots of questions, what is a trading system? And a trading system is basically, it's a formula, and all of these trading systems, they're geared to identify a particular long or short-term state in the market. So something like uptrending, downtrending, is the market going sideways? Is it extremely overbought? Is it oversold? And so that's basically, anything else you want to say about what is the trading system, Tad, since that's a common question we get?
Yeah. So a trading system is a formula, again, based on data that we input, and we include in our data almost every major market index, different kinds of technical indicators like advancing and declining issues, volume indicator, volume, up-down volume, volatility measures, high lows, new high lows, and all these various trading systems may use the same. Some of them use the same data, or they use combinations of the same data but different combinations. And they can again, the formulas are designed to either provide some kind of buy and sell signals by looking at the formulas. Well, again, they can be moving averages, but often relative strength, RSI indicators, oversold oscillators, which generate these signals. But we divide them up into two kinds of trading systems, which we call triggers and filters. Triggers and filters. Filters are systems that could be a market timing system, a general market timing system in itself, a long-term system, which may put you in the market 50% of the time, whereas the triggers are short-term systems that maybe put you in for a day or 2 days or a week. And they work in combination. The filters perform this background of the the background of the market. So if you have a number of long-term filters on buys, then you have a more positive background. And when they combine with these triggers or short-term indicators, they generate these various signals. But the trading systems themselves are these either an independent system like this trigger or a filter. So an independent trading system works by itself, but it doesn't generate a signal to buy or sell by itself. It generates a buy or sell signal for that system, but not for the whole composite or the EVO system.
Great. So back in 2002, again, we started with 40 different trading systems. And of those 40 trading systems, my father selected the 8 very best systems and that's in terms of what are their risk and returns. So we look at a lot of different things, and we're just trying to decide which trading systems to even include in EVO's universe. One example is, what is the probability that the system generates a winning trade? We also look at things like, what are its drawdowns, what's its return while invested. There's a whole slew of things we look at. So these original 8 systems had us invested 37% of the time. Since then, over the years, we've expanded that universe of trading systems which we've looked at to over 120 different trading systems. And now we have over 30 systems in the composite, which helps us capture many more opportunities. We're invested more like 51% now. And also just an interesting note is that in our 16-year history, we're invested about half the time. But if you look at basically since we've been in this bull market since 2009, we've more been invested about 63, 64% of the time.
So 2/3 of the time, close to 67%.
Of the time. Mm-hmm. And prior to that, when we were in the bear market, we were only invested around 34% of the time, between 34 and 37. So we think that's pretty cool. Shows that EVO can identify kind of what's the broader state, what kind of market cycle are we in. So like my dad mentioned, while an individual trading system does give a buy or sell signal, it actually does not give a buy or sell signal for EVO. Rather, when multiple systems are in a buy, they create what we call combinations. And this is just a visual representation of, potential combinations of trading systems. And there are thousands and thousands of combinations. Here are kind of just a few. And what we do is when we see a combination, that is what we're testing to see if we added this new combination and said, okay, this can be an EVO sell signal. If we put it into the current algorithm, the current composite, what is it going to do to the EVO composite? Is it going to improve the performance? Is it going to reduce the risk? If so, like these combinations that are in green, this one and this one, then we will add that combination into the composite, and it will be an EVO forever.
So let me add here, Megan. Mm-hmm. Just wanted to add that, again, this is the process of aggregation. By aggregating different systems together, an individual system will give you maybe good results, but you might have big drawdowns, and you don't want to really use that by itself. But when you combine these systems, where they both have to be, or these multiple systems have to all be on a buy at the same time, what we see is, again, this improved performance, reduction of risk, and you're going to have fewer periods of time when you combine them, because, again, one system alone might be in the market 10% of the time, but when you combine it with other systems where they all have to be in a buy, it might reduce it down to 2 or 3% of the time. So some of these systems don't put you in the market for a long time, but they give you great returns while invested. And again, it's this combination of this aggregation that actually turns individual systems into better performers when they're combined. And then again, as Megan said, that alone doesn't mean that you're going to use that system, because we have so many systems already there. When you add a new system, it has to improve the performance of the overall composite.
Yep, that's a great kind of clarification there. So we run EVO daily. So new combinations are constantly popping up. So when a new combination pops up, then we perform this analysis and see that whether or not it should be included. Now, kind of the question is, does it work? Have we actually evolved the algorithm to enhance its performance? And so what we did to test this is we took the original 8 systems and we said, okay, if we didn't change a thing, if we just ran that original algorithm which we built, what would be our results? This is called forward testing. And if we never ever changed the original EVO, we would have had an annual return while invested of 13.22%, which is really pretty good because during the time the study was performed, from June of 2002 to March of 2015, the S&P returned about 7.45% and an ulcer index of 6.2.
The ulcer index is a measure of risk. It's a measure of risk that you may not be familiar with, but it's one we really like, and it basically measures when your performance is underwater. So the higher the number, the worse the risk.
Yeah, you often hear it described as the pain index because it represents the pain that your clients feel during a drawdown. So we took this and then we looked at what was our actual performance through March of 2015. So this is going to reflect us adding, going from 8 systems to 18 systems, and with that, plenty of new combinations. And we see that we increased our return by 4% to 17.3%, and we reduced our ulcer index. So we reduced that client pain. So with that, we think that the work we are doing is working, and we hope you can see that too.
Yeah, and just one other thing regarding this. This is gross based, and when we did this analysis, we did it gross of fees. We really weren't trying to determine, what you would net. But the important thing here is the relative difference between whether it was net or gross. We would still see that 4% difference increase in enhancement of performance. So even if the net returns will be lower depending on what fee you apply, it would still be proportional. So, but the point explain how EVO works, and then what we'd like to do is get into the actual things you really want to hear about. Is what did EVO do over the last 16 years? And by the way, again, today, May 31st is the anniversary of when the money was first placed in the position for trading EVO, which began on this day, May 31st, 2002. And going forward, EVO is live. And that live performance is shown here. If you go back to 2002, you'll see there's a little asterisk on this start performance table that shows the annual returns. And that asterisk means that we started on May 31st or June 1st. At that time, the market was going down. The market was midway through its bear market. In fact, the market at that point dropped around 27% to its low on October 8th. Actually, I think it went up a little bit from here and then dropped down in June and July. Actually had a big steep decline, ending down at its low on October 8th, 2002. October, I think it was October 7th. And during that period, it came back during the end of the year, but the S&P was down 17%, as you see, 16.99 through the end of 2002, whereas EVO, after the 2.5% annual fee, was down 0.98%. So you see that our first goal was to provide consistent, near absolute returns, and we see that we came close to meeting that goal on a net fee basis. We had the largest losing year of 3.35%, only 3 small down years in our 16-year history. Currently, we are down over 8%, but the year's not over. And the one thing I do want to explain, the major change we made in February, we had advertised in our ADV and our website that we use a stop loss for if we got into a situation, especially since it's a mechanical system, and if the market kept going down, we did not want to be participating. We felt like we needed to have some kind of a stop loss. So we placed a 7.5% stop loss in our system. Now, it started in 2015. We never used that before, and it only would have happened a total of 2 times prior to this year. But it did happen in it did happen this year where we reached that 7.5% level. Now, since we had stated that we would exit if we reached that 7.5% stop, we were obligated to get out. However, we at the same day, we had a buy signal, our best buy signal, and we did not really want to get out. And in fact, in our EVO 2 strategy, which uses discretion, we did not. And as a result, we missed about a 4.5% rally in those ensuing days. Subsequently, we've changed our ADV and our website to state that if we ever do have another, we're still going to keep our 7.5% stop, but if we If we break that level on the same day that we have a buy signal, then we will use our discretion as to whether or not to exit on the stop or actually enter, or if you're already in, stay in on the buy signal of the new buy signal. And again, that buy signal that occurred on February 8th was the best system combination that we have in Evo. So as we move on, after we move from the upside performance to some measures of overall return and then the risk. So since with the 2.5% annual fee applied, Evo, since its inception in June of 2002, has an annualized rate of return of 13.35% versus 8% for the S&P. We've experienced, again, a maximum drawdown of half the market, which is our goal, as we stated earlier, about 25.77%, whereas this is on a monthly basis, whereas the S&P had dropped 51%. Again, the worst calendar year we showed earlier was 2005 with a 3% loss. Our risk measures, semi-standard deviation, which is a measure of volatility, is less than the S&P, even though we're using 50% more leverage. So when you consider taking that into account, when you're using more leverage, you should have higher risk, but our risk was actually lower. Sortino ratio is a measure. It's what's called a postmodern portfolio theory measure. The original modern portfolio theory measure for risk-adjusted returns that many people use is called the Sharpe ratio, which many people may be familiar with. It's a measure of the return versus the volatility or the standard deviation. However, it penalizes you when you have a large standard deviation, which can occur even when you have a large upswings. And that's included in the standard deviation, so you're penalized for that when you use the Sharpe ratio. Postmodern portfolio theory then came up with this new measure called Sortino ratio, which only looks at the downside standard deviation, the downside months when you calculate the this ratio, the Sortino ratio. And on that basis, we're far superior to the S&P. Another thing is how much do we capture of the upside? Well, this measure, upside capture ratio, shows that we capture 81% of the market up moves, not 100%. But we don't need to capture 100% because we miss on the downside more than half of the declining periods. And again, that's with 1.5 leverage. So the other measure we look at is alpha, or risk-adjusted return, another measure of risk and return. And on that basis, we have a positive number, which means that you're outperforming the market on a risk-adjusted basis. The beta, or the correlate, or the volatility of the market relative to the market, is at 0.4, or our correlation to the market on the downside is 0.4. Our R squared, which is another measure really of correlation, shows that we're only correlated to the market 16%. So we're really not correlated to the stock market, and that's what John was speaking of earlier about how our performance does not follow the market down, and it doesn't always follow it up. But you want sometimes to be not correlated to the market, especially when it's going down. The bottom line is that of all our 182 trades, we have 62% winners and 38% losers. But our average winning trade is 3.45%, where our average losing trade is minus 2.18%. So 52% may not seem like a lot, but when you have a system that trades frequently on probabilities, this is considered a very high percentage of wins. A lot of trading systems that trade frequently can have percentage winners of less than 50% and still outperform a buy and hold. The resulting of all these combinations of trades is a cumulative return of 627.71% after the application of the 2.5% fee since inception. Graphically, we see the outperformance historically. In 2008, of course, Evo, or tactical evolution, was up 17% versus the market being down 37%. Again, this was the ability of the system to recognize periods which were going to be very bearish. Now, of course, we don't always, we're not always going to be missing every particular decline, but we really want to make sure that our system is designed to miss the big declines. And what helps here is that a lot of times our long-term filters, like I said earlier, are the background systems that we use that are necessary to be there to generate our trigger trades or short-term trades. During these bear markets, those long-term filters are on a sell, and that's what helps helps us stay out of these major market declines. Now, but then again, there are periods when the market goes down over short periods of time, and our long-term filters are on a buy, and so we will experience some of those declines. But our filters, our long-term systems are designed to recognize, or at least pick up, react to a major market decline early enough to keep us from getting into serious trouble, and that's what they did exactly in 2002. In fact, 2002, if you look over to the left side of that chart, it doesn't look like much, but we were basically in cash most of that period. And you see, at a $100,000 investment in the S&P would have dropped all the way down to $76,000 during that period when we were flat. So there was a 25% drawdown in the S&P where we basically missed almost all of that, and we wound up with just being down less than 1%. So now, we're currently experienced, and this chart goes through March, doesn't show that we're beginning to recover as we have in the past from some of these declines that we've seen, but we experienced a decline in February, and since March, we've actually recovered some of that. So we're not down as steep as as that chart shows currently through May, through the end of May, so it's 2 months ago. I think the one thing to take away from all of this, something that I think is unique, and why is it unique? Well, we have a database based on Morningstar data. It's called Rug and Steel, or Steel Systems. Used it for 28 years, since about 1990. And it shows the performance in all kinds of statistics and measures and metrics for every single mutual fund, every single one in the United States, every single ETF since its inception, and every worldwide market index. There's market indexes in there from Uruguay, Paraguay, the ones I never heard of. And when you add them all up, there's a total of over 30,000. Actually, when this was calculated, there were 30,690 different of these entities that were tracked for their performance and tracked based on 1 year, 2 year, 1 month, 6 months, all kinds of measures, risk, drawdowns, volatility measures, standard deviation, you name it, all these Sortino ratios, Sharpe ratios. Of all those investments, and some are just indexes where you can invest, but they're included. Evo, after applying the 2.5% fee, outperformed all but 7 of them, all but 7. When you take out the fees on a gross basis, which is the manager's performance, our performance, the fees are something that are added on, we outperformed every single one of 30,690 of these entities. Now, I don't know who else can say that. I don't know. Nobody who's managing a mutual fund can say that, because it's outperformed every single mutual fund. Nobody who's managing an ETF can say that, because it's outperformed every single ETF over that period. And we picked this 10-year period. We looked at this at the end of 2016 and came up with these measures and these numbers. So we think that is most powerful, I guess, whatever you want to say, most powerful metric that you can show for our strategy. Summing up everything, again, we don't show backtested results. We use backtests. Everybody has to use backtests to develop a system. Develop your combination, develop your trading systems, your combinations. But to use backtests in presenting performance, we believe is deceiving, very deceiving. Our backtests are far superior to our actual results, and that's the way they should be. But they're optimized. So whenever you optimize in backtesting, you're going to get better results than you're probably ever going to get in real time. And the most important thing is when you're analyzing or looking at performance, so many people out there today are showing their backtested results, and some of them are combining them with actual. They'll show us the period when there's backtesting, and then they'll add on to that little graph the actual period. I know one manager who does that, and if you take a ruler and look at the chart, you'll see it's really great because it has this great backtested performance. But if you put those charts together from the time that went actual, the performance is lower. So you have to be very careful. And again, we do not use backtested results for presenting our performance. We have 16 years of real-time performance, and we believe that's the only way to go. Theta Research, which tracks the performance of active money managers, over 100 active money managers like us. Not long ago, or I guess it was in 2017 or 16, we were the only strategy in the top 4 in performance in all 7 time periods they rank from 1 to 10 years. Finally, our performance prior to our PSI picking up our strategy in 2014, we had our performance verified by a GIPS verifier, and our performance was again GIPS verified through June 2014. We will be working on updating that shortly. Theta Research again tracks the actual model account, the oldest account in the Evo strategy, going back to May of 2002, and they do that on a daily basis. So we have verification of our performance, in several different ways, and we back all our numbers. And thank you very much for taking the time to listen to this, and I hope it'll be helpful. Thank you.
Right. John, did you have any questions for Megan or Rich?
Well, yes. One of the reasons why I put some of my own money into this strategy is because I noticed how that you've been able to rebound after, I guess it's whipsaws or bad market environment for some of the mechanical systems. But even in your second to worst year, 2010, you had some, looks like a 17% drawdown in May, and yet you were able to come back with some tremendous returns. Like in December of that year, you had a 10.20% return and bring that back. Now, do you think this is one of those years where you're going to be able to come back from the correction we had like in February?
Well, even in our back tests, we have periods where we experience those big drawdowns, and it's all based on probability and statistics. Sometimes these declines are, you got to remember, it's a mechanical system. It's looking at patterns in the market, but sometimes those patterns get interrupted by geopolitical events, as we've seen this year. Today you have, we have a week ago, the White House says they're going to put tariffs on hold, and the market rallies. Today, Trump comes out and says, "Oh, we're going to impose the tariffs on the European Union," and then the market turns down. So you can't, it's the mechanical system is looking at patterns. Even if you interrupt the market patterns for a brief period of time, if the pattern is really strong, then it's going to recover, and your data should show and capture that. And that's what we've seen. In 2010, we saw some waves, some whipsaws in our primary long-term system, which caused these declines. But the pattern was there for the market to eventually turn around. And so it's going to catch, it should catch the swings. But again, it's based on probabilities. There's no, we're not taking into account fundamentals because there's so many thousands of different kinds of fundamentals that can affect the market. But we believe that the patterns that in backtests have repeated over and over again and have done well during bear markets. That's what we try and capture and include in our system. But again, nothing's going to be perfect to avoid the decline. We don't, if we have a decline and we experience a decline, the system, again, it's mechanical, so it just goes on and continues. And it's been successful. So, but rebounding, yes, it's rebounded a number of times. We've had eight declines of over 10%, up to 26% on a daily basis. Now, it's going to scare a lot of people, and remember that this is a leveraged product. So when we're down 26%, the market's only going to be down around 17. And if we're looking at it as a one beta basis, if we only had a 1x to the market, then our maximum declines would be say on 17, 18% rather than 26%. Of course, we'd give up some of the gains on the upside, and that's why we use the leverage, because we can come back, and with the leverage, we can recapture some of when the market's going up, we can capture more of those gains, and that's what's worked. We find that 1.5 is just about the right level of leverage that we're comfortable with, because it hasn't, in both back tests and in actual time, in actual performance, it's achieved our objective of reducing the market, reducing declines to less than half of what the stock market experienced.
I think what you're saying, Rich, is really that because you have so much confidence in your program that you can go to 150% because you know that each signal you've got the batting average is pretty good, right? So when you're out, there's a better chance than not that the market's going to be flat or down, and when you're in, you have good confidence knowing that it's a good it's a good buy signal and you're probably going to make money, right?
Yeah, I read an article some years ago. I'm a baseball fanatic, and like a lot of the analytics they use today, and I read this article about batting average, and there's a slump. They did these analysis, and they said, well, when a 300 hitter gets into a slump and he's batting 200, is that really going to affect what he's going to do in the future? And it doesn't. It's independent. I mean, and that's where the math comes in and understanding the statistics, and it's like. So the way I look at it is Evo is sort of a 300 hitter, but he's going to be in slumps at times. But the fact is that if the statistics hold, the patterns are accurate, then you're going to come back and eventually get back to that 300 overall average. And that's the way I look at it. And so we'll go on, and we're doing some other, we have another strategy that applies my discretion over it, and sometimes we're not going to talk about that today, but this one, the Evo is just mechanical, and we feel like it's like a 300 hitter, and eventually, even though there's slumps, you're going to get back to that mean average or whatever.
Well, just in closing, I mean, that's the nice part too that our reps really like, is that you can see over the history. I mean, since 2002, this isn't just a strategy that just came out of nowhere with no track record. And, the fact that it does have such a strong track record, and to your point, John Kimbrough, it does, more than often than not, it always comes back and hits a new high. There definitely are slumps, as you alluded to. The batter gets in a little bit of a slump, but, over the period of time, and then combine that with the evolution part that Megan talked about at the beginning, that this program isn't static. I mean, Rich and Megan are constantly trying new programs and add any other thing they can to make this stronger. So, when your reps, when you guys are out there and you're talking to your clients, whether the rep is playing golf one day or the client's on vacation, this program is continuing to evolve. We'll trade whenever it can, and we'll continue to work every day for you and your clients to make them money. So that's the most important thing when you're talking to your clients. Not only will it help an existing portfolio, but it continues to evolve and get better. So with that, thank you again, John Kimbrough and Megan and Rick. Appreciate your time. And any closing comments?
No, just thank you so much for having us. We really appreciate this opportunity and appreciate everyone who's investing with us. And we know you guys are doing hard work, getting out there and helping your clients. So thank you for considering us as part of your investment strategy.
Great. Well,
great. Thank you very much, guys. Appreciate it. Appreciate being able to tell you about our long-term strategy and everything. So thanks a lot.
Yeah. Terrific. Well, if you have any questions for us, we appreciate it, and you know how to contact us, and we'll be updating paperwork and sales material as we go. So appreciate it. Thanks again.
Thank you.
Thank you.